We are coming live from the Morgan Stanley Summit, and I have with me Chetan Ahya of Morgan Stanley. Chetan, fantastic to have you back on ET Now. Thank you for joining us. Should we start with the realistic and the dim view of the world, or should we talk about something more brighter, like the weather in Mumbai and the fact that there were rainbows on the street?
I think that might be better.
Why are we getting mixed signals from equity market and the bond market? The bond market is telling you a recession stroke slowdown is coming. The equity markets are telling you, let's ignore the bond market, earning expansion is coming and we want to celebrate.
So I see, Nikunj, the framework by the risk market seems to be that the US might be actually muddling through. So yes, there is a slowdown in the US, but the bond market is implying that growth rates would be probably 1.5–2% GDP growth, right? And the Fed is going to be supportive. So that's always good for risk assets, particularly rest of the world outside of the US. But if you get US tipping over to recession, then this whole situation reverses. We've known every time the US is heading into recession, the dollar is rising, emerging market currencies suffer, and you get a financial conditions tightening in emerging markets. That actually hurts their growth. So I think we are just right now sitting in terms of expectation at that cusp where people think that we will get the muddled through outcome, which is good for risk assets. So we'll have to see what happens on June 29th, which I think is a critical date, where we can get a clue of what happens on trade tensions, which will actually determine where the US goes in terms of growth outlook.
Nobody wins in a trade war, whether it's the Americans or the Russians or the Chinese. Everybody wants to protect their turf. Everybody wants to, reach their prosperity goals by exporting. Is the shape of the world going to change dramatically and drastically? Because trade war is something which, frankly, it was not part of the projected template 5, 6, 7 years ago.
Yeah, I think so. What we've described this scenario that we're moving in from globalization to globalization. It is unfortunately looking like real and probably long lasting. So we've clearly moved away from that benign environment where there was predictability on what happens on global trade front into this environment where there's going to be probably continuous uncertainty levels which are going to hurt corporate confidence, and therefore unfortunately it is not a great environment from a medium-term perspective either.
Do you think the American economy has peaked out on all basic parameters, because unemployment at an all-time low, GDP growth at a time when the world is contracting for the quarter gone by for US was strong, the market cap to GDP also for US market is at an all-time high. Can we work with a thesis that it's going to be peak America for next 2 or 3 years, and if the biggest economy in the world is peaking, that would have repercussions for all of us?
That's right, and Nikunj, that is something that we were concerned independently of trade tensions, because you have this situation where US unemployment is very low, and it is properly in late cycle. You had started to see wage growth pick up that was beginning to hurt corporate margins. So all the signals which would indicate that the US in late cycle were already beginning to come through. So as it is without trade tensions, we were worried about the corporate credit risk, because that's what usually you tend to be worried about in the late cycle. Either the household or the corporate balance sheet, whichever is levered up, when cost of capital goes up, could tip over and you could have a bigger slowdown in the economy. And so we were watching the corporate credit risk, the late cycle dynamics in the US. Now these trade tensions have only accelerated and increased our concerns on the US outlook.
You're using the word recession very freely. Now, recession means bad news. Recession means more price adjustment, and recession means that equity markets and bond markets will suffer. Can you throw more light on, when you are projecting a recession, what exactly are you meaning?
So from a global economy perspective, when you hit global growth of below 2.5%, IMF has defined that as a recession threshold. Currently, we are at 3.2%. We were at 4% in first quarter of 2018. So we've seen an 80 bips deceleration. And all what we are saying is that if you do get a bad outcome on trade tensions, and it persists for some time, if it is for a few weeks, it's okay. But the economy will not be able to withstand a severe deterioration in global trade dynamics, which will take this global growth from 3.2 to below 2.5. And that's how we are worried about recession, Mark.
Do you think financial markets are prepared for this contraction in growth?
Definitely not. Our strategists are highlighting that if that is the case, you'll probably see a much severe correction in the risk assets globally.
So in a scenario where world is slowing down and there could be a possible correction in risk assets, which include emerging markets, what will happen to flows, what will happen to liquidity, which asset classes will do better, which asset classes will underperform?
I'm not a strategist. All I can tell you is that generally when you are heading into recession, risk assets do badly.
Okay.
Bond yields would fall. In that scenario of recession where global growth is below 2.5, we're expecting the Fed to take rates down to 0. And that will probably be taking down the 10-year bond in lower further than where we are today.
The concern with some of the global commentators are really talking about it again and again is that beware of the debt what central bankers have on their balance sheet. They do not have the ability also to come out with too many policy changes if global growth slows down. Do you think somewhere we should be cognizant of the fact that central bankers are running out of options because there is a limit to which rates can come down, and that is something which was a weapon available to them last time. This time that also is missing.
Yeah, so we have been highlighting, and in fact, I wrote a long report on this, saying that, in this cycle, in the next downturn, you will have to use fiscal policy more actively because in the DMs, central banks don't have much to cut rates. US has some room to cut rates, but all the other central banks like Japan or ECB, BOJ or ECB do not have any room to cut rates. So they'll have to think about how to have fiscal policy play a complementary role and drive that recovery. We are hearing the arguments, it is in this context that we are hearing the arguments about MMT, a modern monetary theory. I don't think that is the solution. We have existing institutional framework which allows us to use all the tools, and the fiscal policy tool will have to be used more actively to get out of the next downturn.
You mentioned again and again that don't look at Indian economy in isolation, look at what is happening in the world. And I guess if I look at the export growth is at a multi-month low, multi-year low actually now. And if one works with your view, and if I extend that view for another 2 or 3 quarters, if global growth contracts, then we are potentially staring at not bad news but very bad news.
Yeah, unfortunately, that will be a challenge. So what I have been highlighting is that, look, India has already been going through this multiple year of weakness in investment cycle. We've had slowdown in growth, lower nominal GDP growth, because pricing power has also been weak if you look at WPI. That has resulted into lower corporate return expectations. And so in some ways we are stuck in this vicious loop, and we need to have an environment where the financial system is robust enough to support recovery in the economy. Unfortunately, that is not there. The government is working towards it, but it's taking its own time. And you have this window to fix this financial system. If you have global recession in 3-4 quarters, that will create additional problem for India to get out of this, persistent weakness in investment and therefore lower growth.
Do you think the slowdown in India is a cyclical one, or we could be in for a prolonged and a structural slowdown for maybe 12 to 18 months?
I wouldn't call 12 to 18 months as structural. I would still call it cyclical. I think broadly, if you take like a 10-year view or a 5-year view, this is more like a deep cyclical slowdown rather than structural slowdown. India has great demographics. I know that there is pockets of leverage in the corporate sector, but at an aggregate level, the debt levels in India are not that high. So structural story is quite robust. It's that we have got into this deep cyclical challenge, and you can go back in history and keep giving an explanation as to what happened. Not all of it is due to the government decisions. A lot of it is due to the external environment, but clearly the government has not really been working as actively to revive that investment as it should have, and hopefully we see that action coming in through now.
The Reserve Bank of India policy meeting which came out last week seems to be hinting towards growth. Is that the right way to go? Compromise on fiscal right now, but get the growth back. That should be the priority. Don't get obsessed with fiscal.
Well, the RBI is looking at just simple mandate of inflation versus growth. And inflation is looking comfortable, and in the background you have this persistent weakness in investment and growth. So it is, I think, absolutely the right decision from RBI to focus on growth right now because they have comfort on inflation outlook. So I don't think it's at a compromise of inflation outlook. If there was one, then I think that would be a question. But right now it doesn't look like that's a environment.
Attempts have been done to kickstart the rural economy, and some would say that all those attempts have not really seen Food inflation globally is missing. The rural economy is under stress. If government spends too much, there is a challenge on fiscal management. So are we stuck between rock and hard surface? Because if you don't spend, you don't get the fruits, and if you spend, then rating agencies will come out and they'll start, they'll come out with the knives and they'll have the opinions there.
Well, so I think the way you do your fiscal expansion, I think there is room for fiscal expansion. The way you take up fiscal expansion is what rating agencies or independent economists like us will watch. If there is a fiscal expansion for productive investment as well as, let's say, tax cuts for the corporate sector, that would be something that should be viewed positively, because the challenge that India faces right now, even the fiscal challenge, when you go deeper into it, the problem is on the revenue side, not on the expenditure side. So you need to kickstart that growth cycle, and that will be the solution for all the problems that India has, whether it's high fiscal deficit, jobs, etc.
We could be looking at a deep cyclical recession, and the risk of a US recession is, of course, extremely high. Global growth at risk of seeing major slippage. That's the latest coming in from Chetan Ahya, and he has been saying this and really talking about the kind of risks that he foresees currently.